you have to understand, Andrew, that if you're wanting to play with real estate right now, to a certain degree, you're playing with fire. And I'm not saying don't do it. I'm saying understand the risks. And my main point, and Hartman would agree with me, is the property, you have to look at it as the liability. The asset is the 30-year fixed rate mortgage. Because the probability is that you're going to lose purchasing power with the property. Just like back in normal times, let's say the 1980s or the 1990s, you would have lost money with the loan because you got to pay it back with interest, right? So you got to pay back more dollars than you actually borrow. Therefore, you're going to be losing purchasing power on the loan. Everyone knew that. Well, then why the hell would they buy a house? Because they believed that the appreciation in the cash flow from the asset itself would more than make up in terms of purchasing power for the loss of purchasing power of having to pay back that loan with additional interest. And if it's a rental property, obviously your tenants are paying that, you're not. But now it's the reverse. If we're just looking at equity, then I believe, as far as the purchasing power, that the probability is high that you will lose purchasing power on the property, just like you would lose purchasing power on the loan before. So it's still A plus B still equals C. It's just they've reversed roles. Now before it was A plus B equals C. Now it's B plus A equals C. But you've got to be aware of that because you got to be aware of the risks. You see, and then I think that you're going to increase your purchasing power on the debt side by owning that 30-year fixed rate mortgage. That over time, and I'm not saying the dollar is going to go straight down. It could appreciate. Who knows? We could see deflation, outright deflation. I don't think we'd see it for a long period of time. I would definitely see it in asset prices, maybe more disinflation in consumer prices, but who knows what we see, right? But I think over a 30-year time, if you've got a rental property that's positive cash flow, in essence, you're being paid to short the dollar. So I think you would increase your purchasing power more on that dollar short position than you would by the decrease in purchasing power on the property going back down in price to its historic trend line, which is where we were in 2012. And to be clear, it doesn't have to go back down to its historic trend line in nominal terms. It can go back down to its historic trend line in real terms, adjusted for inflation. So housing prices could go up for the next 20 years in nominal terms, but we could still go back down to the inflation adjusted prices that we saw in 2012, which, oh, by the way, were at the historic trend line going back to the year 1900. Over 100 years of data. Over 100 years, housing prices did not go up, adjusted for inflation. So if housing prices didn't go up, adjusted for inflation, from the year 1900 to the year 2000, and again in 2012, then why should we assume that for some magical, mystical reason that housing prices won't go back down to their historic trend line? No, the probability is extremely high that they go back down to that same point they were in 1900, the same point they were in 2000, and the same point they were in 2012. Why? Because housing prices are just a reflection of incomes. You see, and incomes is, to a certain degree, is an extension of inflation. So you got to understand that. But like I said, it's I'm not saying don't do it. I'm saying if you're whatever you do, make sure you're doing it with your eyes open.